Welcome to the Ontario Mortgage and Real Estate Insights Podcast, Episode 10. I am your host, Steve Hamowen. Today, we're diving deep into some of the most pressing issues affecting the Ontario real estate market. From rising condo fees to the challenges of hiring qualified managers, there's a lot to unpack. Let's get started with our first topic, the rising condo fees exacerbating Ontario's housing affordability crisis. A shortage of qualified condo managers is driving up costs for homeowners in Ontario, threatening to increase fees even as new units become available. Many experienced managers were forced to retire in 2022 due to changes in training and licensing for condo managers. Eric Plant, president of the Association of Condo Managers of Ontario, spoke to Global News about the issue. The demand for educated managers is just skyrocketing, and the supply is plummeting. That's kind of created the issue we're in now, Plant said in an interview with Global News. As a result, salaries for new condo managers have increased significantly. Some are starting their first jobs with salaries as high as $80,000 per year, which is ultimately driving up annual fees for condo owners. It's hitting people very hard. It's not helping the affordability crisis, Plant said. The worst thing you can hear when your mortgage has just gone up and you've gone from 2% to 7% is to get a letter from your condo manager saying we're going up 6% this year, 10% more. It's a lot to swallow. The industry saw major regulation changes in 2017 with the Act, which introduced licenses for condo managers. However, the transitional licenses that allowed long-serving managers to continue working expired in mid-2022. Many seasoned condo managers, already comfortable in their roles, saw the retraining as unnecessary and opted to leave the industry altogether. Plant estimated that between 10% and 25% of the most senior people in the industry left overnight when transitional licenses expired in mid-2022. The industry had a lot of problems. There were some major cases of fraud and other things that made the news and sort of prompted this, said Plant. So no one in the industry was upset this happened. Ontario currently has 4,564 licensed condo managers responsible for managing approximately 12,690 condo buildings with over 900,000 units. The number of managers is not keeping up with the demand as the province continues to add new units. In 2023 alone, 11,422 new apartment units began construction, with another 13,245 new units starting in the first quarter of 2024. The buildings being built now are far more complicated, Plant noted. They're being mixed with commercial, there are hotels in them, there's short-term rentals, there's really complicated sharing facilities. The more in the middle of the city you are, the more complicated it gets. Anne Burgoon, a property manager and vice president of Eastern Ontario Property Management, said finding qualified managers is a significant challenge. There's quite a challenge in hiring managers. They're making really good money now, she said, noting that entry-level administrators now earn between $60,000 and $80,000, compared to $40,000 just a few years ago. When you have this kind of economic mismatch, your prices go up and the prices of managers have skyrocketed, Plant added. 3 years ago, I was paying half of what I am paying for a limited junior license. Now, it's probably gone up between 50% and 100% in 3 years. Senior managers can earn between $120,000 and $220,000 per year. But, with many experienced managers leaving, junior managers are often handling more than they should. Because of the shortage, you have junior managers running a lot more than they should be running under a lot less supervision. We're doing all we can to train as fast as we can, to make sure the ratios are good, but the reality is what it is, Plant said. If you've got a junior building and you've got lots of buildings, and you need someone to run them, you're going to be putting that person into probably a bigger portfolio than they can handle. The ultimate result is rising condo fees. As management companies pay higher salaries, they increase their contract costs, leading condo boards to raise fees. While the price of a condo manager is a relatively small part of the total condo fees, other expenses are also increasing. Building costs have gone up significantly, but management fees have gone up significantly as well, because of all of this and the challenges we're having in keeping staff, Burgoon said. Neither Plant nor Burgoon expects an immediate solution from the provincial government. They hope that high salaries and more structured training will attract more graduates to the profession. These regulatory bodies were not there, so they built them from scratch over time, Burgoon said. And have there been bumps and things to iron out? Yes. And will they continue to do so? Yes, I imagine that they will, Burgoon said. An Ontario government spokesperson said neither the government nor its regulatory body have a role in setting condo managers' salaries. The government is aware that the growth in condo housing has resulted in an increasing need for condo management, they said, adding that the government would continue to monitor trends in the industry. A home sold at a staggering $800,000 loss is just the latest example of a property in and around the Greater Toronto Area selling for much less than its original price tag. Located in Oshawa's Eastdale neighborhood, this 4+2 bedroom, 6-bathroom home boasts a gourmet kitchen with a walkout to the deck, a main floor office, a gas fireplace, a walk-in closet in the primary bedroom, and a finished basement with a sauna. The custom-built home was originally sold in March 2022 for $2.55 million at a time when cheaper borrowing rates resulted in heightened demand throughout the province's real estate market, which in turn drove prices up. In April 2024, the home was put back on the market for $1.78 million, but failed to attract any buyers. After its first failed attempt, the home was relisted for $1.799 million and eventually sold for $1.75 million, exactly $800,000 less than it sold for just 2 years earlier. The home was reportedly listed as a power of sale, which differs from a regular home sale. The clause is usually written into a mortgage note that authorizes the mortgagee to sell their property in the event of default to repay the mortgage debt. As a result, the lender forces a sale on the public market and gets all the funds owed to them, while the current owner gets to keep any excess profit. In a foreclosure scenario, the lender usually takes ownership and gets to keep all the profits from the sale. This Oshawa home is hardly the first to sell well below its original price in 2024. A 6-bedroom Brampton home sold at a significant loss of $600,000 in January. An 11-bedroom home in York University Village sold at a $400,000 loss in May, and a Cambridge home sold at a mind-boggling $825,000 loss in June after multiple failed attempts to sell. According to one of the Canadian Real Estate Association's latest reports, May was a relatively uneventful month for many Canadian housing markets, as the national month-over-month home sales edged slightly lower. This meant that some prospective buyers benefited from more wiggle room when negotiating lower prices. Home sales activity recorded over Canadian multiple listing service systems dipped 0.6% between April and May 2024, remaining slightly below the average of the last 10 years. However, the Canadian Real Estate Association's senior economist Sean Cathcart notes that this may be the last sleepy month for housing activity in Canada, now that interest rates have moved lower. Nearly 4 out of 10 Ontarians are considering leaving the province due to the high cost of housing, according to a new survey by the Angus Reid Institute. The survey, which polled 4,204 Canadians last month, found that 28% of all respondents were contemplating a move out of their province because of housing costs. However, this number jumps significantly for Ontario residents, with 39% considering a move, the highest percentage in any Canadian province. The survey also revealed that British Columbia had the second highest percentage of residents mulling a move elsewhere at 36%, followed by Nova Scotia at 25%. The high cost of housing is pushing many Ontarians to consider relocating to more affordable regions. Among those in Ontario who said they were seriously contemplating leaving the province, about 26% listed abroad as their most likely destination. Alberta and the United States were next on the list, each with 17%, followed by Atlantic Canada at 14%. This shows a significant inclination towards leaving not just the province, but the country altogether for some. The survey results point to a generational divide as well. Ontarians between the ages of 18 and 34 are nearly twice as likely to say they are contemplating moving due to housing costs compared to those 55 and up. Specifically, 46% of younger Ontarians are considering a move, compared to 26% of those in the older age group. New immigrants are also more likely to consider leaving Ontario due to housing costs. About 39% of those who have been in Canada for 10 years or less said they were contemplating a move, compared to 28% overall. The number drops to 30% among immigrants who have resided in Canada for 11 years or more. The high cost of housing is not just a personal burden, but could also have broader implications for Canada's reputation as a welcoming country for newcomers. The survey notes that Canada has historically been viewed as a role model by the Organization for Economic Cooperation and Development for Labor Migration and has outperformed most countries in economically integrating immigrants. However, the high cost of living, particularly housing, may be harming this reputation. Despite these concerns, there is still some optimism among Ontarians about the future of housing affordability. 58% of Ontario residents surveyed said they are hopeful that housing affordability will improve over the next few years. This is slightly higher than the 53% of Canadians overall who share this optimism. The survey was conducted between June 14th and June 20th. According to Angus Reid, a probability sample of the same size would typically carry a margin of error of 1.5 percentage points, 19 times out of 20. Let's talk about the recent provincial announcement that Ontario will keep its rent cap at 2.5% for the third consecutive year. This decision is aimed at protecting tenants amid rising housing costs. The cap is set to be the lowest in the country, coming in below the average inflation rate of 3.1%. Under the Residential Tenancies Act, this cap applies to the vast majority of rental households in Ontario, which amounts to about 14 million households. It represents the maximum amount a landlord can increase rent during the year, without the approval of the Landlord and Tenant Board, also known as the LTB. The guideline for the cap is informed by Ontario's Consumer Price Index, which is currently at 3.1%. Last year, the province decided to hold the cap at 2.5% in response to rising interest rates that would result in higher rent. And it appears that this is the reasoning this year as well. Without the cap in place, many landlords would be able to raise rents by 3.1% in 2025. Landlords with units under rent control do have the option to apply for an above-guideline increase through the LTB. However, they must first prove that a higher increase is warranted. One example of an extenuating circumstance is if the landlord has made substantial improvements to the rental unit. It is important to note that the cap does not apply to all rental units. It has no effect on rental units occupied for the first time after November 15, 2018, vacant residential units, community housing, long-term care homes, or commercial properties. These unit types are not subject to rent controls, so there is no limit to how much those rental providers can raise rents. Additionally, rent increases are neither automatic nor mandatory. They can only be issued 12 months since the last increase, and landlords who wish to raise rent are required to give 90 days written notice. The provincial government's decision to maintain the rent cap at 2.5% is seen as a measure to protect tenants from steep rent hikes. However, it is also a balancing act to ensure that landlords can still cover their costs and maintain their properties. As housing affordability continues to be a significant issue, this cap aims to provide some relief to renters in Ontario. In a significant move to address housing affordability, the Toronto City Council has approved a $351 million investment to jumpstart 18 affordable housing projects. This capital spending aims to speed up the construction of nearly 6,000 new rental homes, including 2,600 affordable and 3,380 rent-controlled units that were previously stuck in pre-development phases. According to a background staff report, this first investment under the new program will help unstick almost 6,000 new rental homes, moving Toronto closer to its ambitious goal of creating 65,000 affordable residences in the city by 2030. The report highlights that nearly 48% of households in Toronto are renters, with 40% of them living in housing that the 2021 census data defines as unaffordable. The council also voted to provide up to $260,000 per unit in funding for new rent geared to income and affordable rental homes. This amount is triple what the city was planning to pay per unit last year under its former open door program. Councillor Brad Bradford, who supported the motion, emphasized the need for this increased funding to meet the city's housing goals. Mayor Olivia Chow stated that the funding includes additional spending on community supports for tenants over the long term. The new program also provides incentives to help nonprofit, co-op, and indigenous housing providers advance affordable rental projects. These measures aim to support the creation of homes, with rents capped at no more than 150% of the city's average market rent, with limits on annual rent increases. Mayor Chow introduced amendments asking the provincial and federal governments to finance approximately 6,000 new rental homes in the city, while renewing the city's request for expanded provincial rent controls. These amendments are part of a broader strategy to make housing more accessible and affordable for Toronto residents. The affordable rental program comes on the heels of a staff report indicating that Toronto faces a severe lack of affordable and supportive housing for low-income residents. Rising rents have made the city increasingly unaffordable for middle-income earners as well. According to the Toronto Regional Real Estate Board's first quarter 2024 rental market report, the average rent for a two-bedroom condominium apartment unit in Toronto is $3,139. In addition to the $351 million investment, the council marked the one-year anniversary of Mayor Chow's term in office by approving a deal that will see city-owned lands combined with private property to build 447 new purpose-built rental homes in Midtown Toronto. In partnership with Collective Marquee, the project will combine city property at 275 Merton Street with an adjacent site owned by a developer. The project includes a minimum target of 30% affordable rental homes. The adjacent privately owned property at 267 Merton Street will be transferred into city ownership and then leased back to Collective Marquee along with the city-owned site for a period of 99 years. Collective Marquee will deliver and operate the new rental homes, while the city will retain ownership of both properties. Construction is set to begin in the second half of 2025, with first occupancy expected in mid-2028. Staff in the background report noted that Toronto is facing a lack of affordable and supportive housing for low-income residents, along with rising rents that have made the city increasingly unaffordable for middle-income earners. These new investments and partnerships aim to alleviate some of these pressures and provide more affordable housing options for Toronto residents. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for joining me, Steve Hamoen, as we navigated through some of the most pressing issues affecting the Ontario real estate market. From rising condo fees and significant property losses, to the high cost of housing pushing residents out of the province, and finally, Toronto's ambitious plans to increase affordable housing, it has been an insightful discussion. Be sure to tune in next time for more updates and expert insights. Until then, take care and stay informed.